S&P recently tested a key level not once, but twice. Since we broke the 200 SMA, we've been unable to close above it. A quick glance of the weekly, our trend line is about as perfect as you can get. Nasdaq weekly is riding the same line. We are starting to see signs of comparisons to the bottom during the pandemic. Now, to understand where we're going, we have to understand where we have been, and we have to understand what has transpired that led to this. Subscribe to the channel for daily updates and education and potential stock setups. I purposely don't run ads, so I appreciate when you smash the like button, as your support helps me with the algorithm and gets the message out there. During this topping pattern, right up here, is when we started inflation talk, the possible not buying of bonds, the Fed having to sell bonds, and possible rate hikes. And we started the is inflation coming at a rate that is transitory or not? And obviously it has not been transitory. This is why we sold off, due to the easy money of the Fed coming to an end. This week we had probably the most important economic data that we've had in about 2 years. Put this in perspective, in front of us is the CPI month over month. I just want to point out that we have not had a negative month over month reading except in April and May and June of 2020. And we just got a negative reading. You can see the negative reading on January 12th, 2023, and not another one until you get to April 10th, 2020. CPI year over year came in at 6.5, which was our actual, and you can actually see the trend and how it's dropped. But more important, you have to go all the way back to 2021 to find anything lower than 6.5%. This is absolute CPI, meaning price of goods and services in absolute terms. It is extremely rare for this to dip. We can see that dip in 2009 during the great financial crisis, and we can see that small dip during the pandemic. Currently, the December reading was 298.10. This decline from December that I drew in marks right around where the recent reading came in, around 296.50 or 296.70, right in there. So we have an absolute decline. CPI pricing. The only other two times we've had this in the past 15 years, great financial crisis, pandemic. So this is what we know. We know this started due to inflation and the eradication of the Fed funds rate being at zero, and right now have the lowest month over month reading and lowest absolute drop in CPI since the pandemic. This is how it started. This is where we are. All we have is where we are. We don't know about the future. We're going to get into talking about earnings and everybody's concerns with earnings and why I'm no longer very concerned about them. But we need to look at the technicals, because the technicals tell you what people are doing, not what they're saying. Back here during the pandemic, we have a death cross. I use a 55. The 55 crossed the 200 to the downside. Then we have the golden cross, which led to about a 2-year bull run, something we probably haven't seen this strong in about 20 years. Here we have a death cross. Within 2 weeks, all things being equal, this will be a golden cross. Now, we don't need the Nasdaq to go up at the same pace as the S&P, but we do need it to stop going down. Right now, we have a death cross, and we can see the width of these are much further apart than the S&P and still declining. There are signs that we are putting in a bottom. In blue is the Zweig breadth thrust indicator, denoted by the white arrows as to their place on the Nasdaq and also their place on the reading. The reading is relatively simple. Anything above 60 is considered overbought. Anything below 40 is considered oversold. The issue with it is it doesn't really work that way. In other words, the way that it usually works and the way that most people use it is they use the thrust indicator as an indication of the trend continuing. In other words, when it breaks down, we expect that trend to continue down. When it continues up, we might get a little pullback like we did here, but that trend will continue up. The reason is because of what this calculation is. This was developed by Martin Zweig, famous hedge fund, worth reading about. The indicator is calculated by taking a 10-day moving average of the number of advancing issues divided by the number of advancing issues plus the number of declining issues. Since it is a percentage indicator, it cannot go below 0 or above 100. It is rare if it goes below 40 or above 60. This is used as an overbought or oversold. I just want to expand on how rare this is. July 2016 was the only other time in 10 years that it happened. Below in green and red are the Nasdaq new highs and new lows. You can see clear how we are hitting significantly less lows even as the market went down. This is what we refer to as a positive divergence. If you just think about it realistically, what are the chances of a market continuing to drop if the components of the market are not making new lows? Pretty rare. In regards to earnings, it's actions, not words. What do I mean by that? I don't care if a company has bad earnings. If the stock goes up, somebody's buying it. It means that it's discounted in the price of the stock already. Case in point, here we are last quarter with an absolutely abysmal quarter in JP Morgan. From that quarter on, the stock rallied about 40%. Fast forward to today, bad quarter, increasing reserves for losses. Jamie Dimon's out talking about uncertainty and whether or not there's a recession. The stock touches our stop level, bounces right off of it, and then continues to push, having a $10 move today on average volume. Make sure you get the newsletter so you can follow along with ideas like this. Link in description. This is when we traded in the Alpha Chasers community this morning. Very simple trade. You can see your first bar down, just shaking everybody out, and then it just starts building up on this 1 minute chart, sets up the pop, got in right around here on this close, and then we just start selling into the rips. Now, whether or not you scale out or you hold to see if you get the gap fill quite nicely with this, and also had the position previously. Not only did we gap fill, but we went way past the previous close and went right to our resistance point or trim point on the longer position that we had that is a swing trade. The reason I'm showing you this is because I get asked a lot to show these and show trades that we actually do in the Alpha Chasers community. And this is a glaring example of one that when you understand the story and you know what your process and patterns are, this gets very easy to just look for a pattern and see if it's going to replicate. And that's exactly what happened right in here. Rallied right up to this level. Whether you sold into here or you decided to hold on is completely irrelevant. What's relevant is being able to spot this and then manage your risk throughout the trade. This is not done. You're going to want to watch that 143.59 level. You flip that level, you can see 160. I know everybody is saying, well, what about interest rates? What about mortgages? You're not an economist. Your job is to trade. Your job is to make money. The economist will come out later and explain why the market did what it did. Meanwhile, stocks are going higher. As a trader, it's our job to trade and to make money. We can discuss this. We can talk about the CPI, but at the end of the day, really quick tip here, start running scans on golden crosses. I use a 55, but start running scans on golden crosses, death cross to golden cross. These are going to be just absolute, the highest probability setups that you're going to have out there right now. It tells you that you have institutional sponsorship, okay? Retail is not buying JP Morgan and doing this. Now, another reason why I'm not concerned. So now we have this company that is an online retailer in an area that's going through a tremendous amount of turmoil. And what do we have? Look at the outsized volume. Look at my golden cross that's starting to develop in here. Look at my levels and how I'm running right to them and testing them. I'm not even backing down. Look at this on a 15-minute chart. Got right to it, rejected, pulled back a little bit, and that's it. You're not seeing those big pullbacks anymore. You're seeing tests, stops, and then possible retests. Millie has earnings in 25 trading days. Now, why is that important? It's important because you're going to go in and your comp for next year is going to be March 2022. And we all know what happened to online sales last year. Declined precipitously from 2021. You're going to have good comps on online companies this year. Your year-over-year comps from 22 to 23 are going to be good. Shop is another great example of this. If you start going through this and you look at 21 and you look at the earnings, and then as you get into 22, you just start seeing them dissipate. And now you're taking losses. So now you're going to start having these comps into the next quarter. Note the death cross. Now, if we zoom in here and just do a really quick calculation by looking at these two lines, we're going to have a golden cross in about a week or two. This is another one that we did in the trading room today. Did not act the way that I wanted, but I think we're just getting started here. Here's our death cross. Here's our golden cross. Tried to gap fill, fail, fail, fail. Resistance becomes support. Resistance eventually becomes what? Support. It's just a matter of time. We've got a golden cross. We know what we have. We have earnings in 3 days on Netflix. And this is going to be the first quarter where they're going to show their ad revenue. and how they're doing. To put this in perspective, you have not had Netflix running up 30 days before earnings, about 18 months. We can see it declining from here. We can see it declining before earnings here. You have a little move here, not really, not really. Look at this move. Look at this power move going into earnings. That tells you how people are positioning. Do I think earnings are too high for some companies? The answer is absolutely. Do I think they might be too high on the S&P? They very well could be. But it really depends on how much of that is baked in. And right now, I'm not seeing it. Now, we're going to see a lot more as time goes on, but we're coming into Tesla. Now, January 25th, we're going to have earnings on Tesla. This is a great example of a company that just might have an all-around bad quarter. We're sitting on a major support level, trying to hang on to it. The entire market rallied today. You can see all my levels right here. The entire market rallies today, and we're unable to get over very simple minor resistance points. Cutting prices in China, cutting prices in the US. Car and Driver, I believe, has them at 15 right now. There's some issues here, and we could see something like this actually continue to get weak. We saw this happen in 2002. These companies, they don't all come back. A matter of fact, hundreds will probably still go out of business, but 3 or 4 are going to be around, and they're going to be ultra successful, just like the Amazons and the Googles of the world. Taiwan Semi, excellent quarter. Why was it an excellent quarter? Because the capacity utilizations were not down as much, meaning that they're actually setting up to start retooling. If you read some of the investment banking pieces that are out there, and you look at some of the top 4 trends that are out there, I'll link that video at the end, the top 4 trends for 2023. What you're going to notice is something really very critical, that we're starting to see the foundries like Taiwan Semi, which is now above the 200-day moving average, has not been above the 200-day moving average since about 12 months. And we're there now. We can see how the 55 is curling up, and you're probably about 4 weeks away from a golden cross if the stock simply stays stagnant. If it goes up, it'll be there sooner. If it drops below the 55, it will take longer. Semiconductor equipment manufacturer KLAC Corp. breaking out above major resistance. ASML golden cross after the death cross, breaking out higher highs today. Notes from the Alpha Chasers community. If you're interested in joining the Alpha Chasers community, just click here in the top right. There is a wait list. Simply click on the link and you will be added to it. Now, in regards to this, what's going to happen here? Golden cross, right? We're going to flip again. We're going to get a golden cross. Look at that close. So in other words, I have a higher high close above the 200-day. When was the last time that happened on the semiconductor index? What's the difference? We had a declining 55. Do you have a declining or inclining 55? Is the slope down or is the slope up, right? It makes a difference. It makes a huge difference. Doesn't mean that we still don't have a declining 200. Does not mean that you can't get under here. And this, frankly, is not resistance until it is resistance, right? It's got to stop there, reverse, to be actual resistance. I think it's very telling that you ran up, didn't take out new lows, couldn't get past the 55, and now you're setting up to push. When you go through the next upcycle, it's the semiconductor equipment manufacturers, the foundries that outperform. They are going to outperform the NVIDIAs and the AMDs of the world. In regards to earnings, again, why am I not concerned? Because I'm watching how they are treating the corporations that are coming out with earnings. Lulu, absolute dumpster fire of a quarter, but they alluded to the fact that once they get through this inventory, that's pretty much going to be the end of it. And they see the consumer starting to get a little bit stronger. So they were looking for a reason to buy the stock, and they found one. This is one we bought around 301.50, and we've just been trading up into it. My goal is to try to get through that 320. I have common stock and options on this. And what we're trying to do is see if we can get up in here and get a full gap fill. I'm not sure we're going to get it, but what I would do is I would watch names like this. I would not rule out this trade. In other words, if it goes sideways for a bit here and then breaks out, I'd be watching these next week. KBH is another one I would have on my radar. Here's our golden cross after our death cross up here. What I like about this is you had cancellations of 68% on new homes. What people are missing out is the inventory for new homes being constructed is that of 1960. So when pending home sales actually start to go up instead of down, you're going to hit an entire new upcycle here. and home builders. And they're not getting this. We have limited supply of apartments. If you talk to people that are out there trying to get apartments or rent apartments right now, they're still having issues because of the limited supply of housing. It did not go away because interest rates went up. It just became more expensive. Very different than 2008, 2009. All you have to do is go look at pending home sales in relation to inventory. Actually, let's take a look at this right now. This is one of the most misunderstood trends of 2023. Let's start with the facts. This is Realtor.com. This is active listing count. Here we are in yellow, 2022. Okay. We are not even remotely close to where we were in the past. We're nowhere near on listing count near 2020 yet. We are not anywhere near 2021, right? We're not there yet, okay? But we are rolling. 57.4% active listings are up. Okay, so listings are up. That much we know. Are we anywhere near previous levels? No. Property count. You look over here and you look at the graph, you are at half the count of listings as you were 5 years ago. Did we add or lose people to the United States in the past 5 years? Okay, so you are at half the inventory in active listings that you were 5 years ago. Total listing count in yellow is 2022. You can see clearly that the only time that was worse than that was going to be the 2021 period, right after the pandemic. 2022. Newly listed homes are down 21% year over year. Why? Affordability. People cannot afford to move, and there is no inventory. If you look at regional statistics, you can see that your active listing count year over year is up. Your new listing count is down double digits. So what's on the market is staying on the market. They are not adding new homes to the market. They are decreasing the likelihood of listing their home on the market. So what's on there is staying on there. Meanwhile, the median listing price year over year is still going up. New home sales rise 5.8% prior from month in November. Now, if we look at days on the market or homes sitting, here we are sitting right around 56 days. They're saying 8 days higher year over year. Not exactly a meltdown when you look at 2021, they were sitting there longer. And then you look at the past 5 years and how long the median days on the market were. The entry level. Demand exceeds supply at entry level price points. The situation was even more challenging for shoppers looking for homes between $90,000 to $310,000, where the shares of homes on the market were notably lower than shares of homes getting views. Within this range, 1.2 times higher than the shares of listing. New home sales actually rose 5.7% in October. This shows new home supply. So in other words, once you're done the house, Toll Brothers, KBH, Lanier, once you're done the house, how long from when you're done is that house sold? You're at the lowest reading that you've been in 5 years. Now, this is absolutely staggering. Here we are, the gray line is completed. New homes for sale by stage of construction. So the gray line is what is completed. If you go back to 2000, you will see that you are at a 20-year low for new homes for sale by stage of construction that are completed. There's nothing for sale. What they're doing is they're selling homes that haven't even started yet or that are under construction. This graph shows the cumulative shortage of new home supply from 2012 to 2022. You're currently cumulatively short 5.8 million. This is why names like KBH are going to continue to go higher. Toll Brothers, another one that we started around 47.5, 56. Looks like we're going to get to about that 60-40 level. That'll be our next possible trim spot. Pulte's Golden Cross continues to push. Like to see this pull back. Not sure if we're going to get that opportunity. Really important for people to get this particular time and start doing their own homework. If you liked what I did there with the home builders and you'd like to see more of that, just let me know below. There's a lot of misinformation. Just comment below. Please like the video if you found it helpful. Have a great day.